the market right now is really on a Fed deficit spending rampage, so to speak.
Yeah.
It's really fueling this market.
Yeah.
And with the Fed's raising of interest rates over the course of the last 3 or 4 months, investors are of course getting very nervous because they feel the punch bowl is being pulled away.
Oh yeah.
And he made a statement, right? He makes a statement that, we're going to stay on this path of rising rates, which
we're going to raise rates
in
three
reality,
more times.
Yeah, in reality, it's probably the right thing to do because interest rates are still very, very low.
Yeah.
But it makes investors nervous.
Yeah, well, get the investors through a temper tantrum because they're like, we want our punch.
Right.
Don't take the punch bowl away.
And probably it's a little bit disappointing that he then 3 weeks later makes a knee-jerk reaction to the nervous investor.
Which I'm happy he did because it shot the market up a lot.
It makes our job a lot easier because the market's going up. But
there is the whole issue of, it's like the junkie needs a fix.
That's right.
The market wants its hit, and sometimes, getting it sober.
Yes.
I'm pushing the analogy
That's
too
right.
far now, but
it's always a fine balance between what's the right thing to do. Make sure the economy doesn't get overheated.
Yeah.
Which is what the Fed is trying to do.
But that means letting the stock market have a hit.
Yeah, or do you keep the punch bowl out there and let the stock market get overheated?
Right.
Both of them have big negative impacts.
There's a real thing.
Yeah.
The wealth effect's a real thing. If the market takes a hit bad enough, I know our clients will start to, I don't need to buy that new car. I don't need to upgrade a house. I'm gonna just retrench and spend less. Yeah. So it really will affect the economy. The stock market will affect the economy.
Yeah. But if they let the economy get overheated, it affects the economy too, because inflation gets too high, right? And all
capacity
of a sudden
gets built out too much, and then and really that's, if we talk about volatility, why does the Fed do this? A client asked me probably last week, well, why is the Fed doing it? Why would anybody raise interest rates? And I had to explain, 100 years ago, or before that, the economy swang wildly. The booms were boomier and the busts were really hard, and they wanted to cut that out. And so the Fed comes along and they'll hit the brakes by raising their rates when times are good, and when times are bad, like 2008, they'll print money, they'll lower interest rates. But there's a lot of people, maybe myself included, that thinks, I don't know how well you're going to manage that forever.